Hello everyone, my name is Lawrence and thank you so much for watching my channel. A channel talks about investing in the stock market and also talks about financial independence. If you're new to this channel, please consider subscribing such that you don't miss other videos like this. Today, I'm going to be talking about a question from a subscriber, and his question was, how can you read financial reports? And how can you use these financial reports to decide on what company to buy or what shares to buy? So this is the topic that I'm going to be talking about, and I structured it into three sections. Number one is defining what the financial statement is. Second is I'm going to be talking about the three types of financial statements that you need to read through if you're reading a financial statement. Third is I'm going to go direct to a company report to show you exactly what I'm talking about and what the figures in the report mean. So join me to go directly to the reports. So as I said, number one section is defining what is financial statements. Basically, financial statements are the formal records that convey business activities and the financial performance of a company. So you can see from the definition, it has two main important sections. Number one is business activity. So basically, if you're going to read financials or financial statements of a company, there are two things that you will be looking for. Number one is, what does the company do, or the businesses that it is involved in. Second is the financial performance of the financial strength of the company. Is it in debts? Is it making profits? Is it making losses? So those are the two things if you're going to read a financial statement that you will be looking for. So there are three main sections or types of financial statements. If you're going to any company financials, you'll be looking for. Number one is the balance sheet. So balance sheet, just basically it's an overview of the assets, liabilities, and also the owner's equity. So there are three things in the balance sheet. So second statement is income statement. Income statement mainly is profits and loss. So it is stating the losses or the profits of a company. So what number three is the cash flow. So cash flow mainly, there are two things that are involved in cash flow. Number one is the income generating activities of the company, or the inflows of the coming income for the company. Second is the outflow, or the outgoing, or how does the company spend money. So that's basically the three types of the financial statements that you should look for. But because this is a very broad topic, I have decided for today to only concentrate on balance sheet. When you get time, we shall talk about income statement and also cash flow. So let's go in a bit detail about balance sheet. So what is a balance sheet? As I said before, it is just an overview of company assets, liabilities, and also stock or owner's equity in a given period. So it also has three sections. When you're looking at balance sheet, you'll be looking for three things. Number one is assets, liabilities, and shares equity. So what is asset? Maybe you know it, maybe you don't know it. Just asset is just any economic or viable or productive asset that you own. Maybe it generates income, or it can generate income in the near future. Basically, that's what is asset. So when you go to the balance sheet, you will have to find two main types of assets: non-current assets and current assets. Non-current assets, they are just assets that are long term or that can generate income in the long term. So those are non-current assets. So they mainly is a property like buildings, cars, and also intangible assets. Intangible assets, they just like the patents, the software, if there's a computer company, and also other kind of rights that you cannot see. Second is the current assets. Current assets is the short-term assets like cash, bank deposits, bonds, and bills. Basically, that's what assets means. Second is liabilities. Liabilities, in short term, is any cost to the company, like debts, salaries, wages, taxes. So anything that costs company, it goes to liabilities side. So that is liabilities. Number 3 is equity, shareholders equity. Mainly shareholders equity is basically total assets you subtracted by total liabilities, it gives you the shareholders equity. Basically, those are the 3 things that when you go to a balance sheet, you will be looking for. So under shareholders equity, there is also share capital, there is a share premium. So basically, those are the 3 sections that you will be talking about if you're talking about balance sheet. So let's go to a third point, that where we have to go to the balance sheet. I chose one of the companies that is in Kenya. It's Longhorn Publishers. The reason why I chose it, it's because it's simple to understand. So after knowing this, how to read this balance sheet, you can go ahead and read more complex balance sheet after understanding this kind of meanings and statements. So as we said, in the balance sheet, it says our financial statements as at 30th June 2019, consolidated statement of financial position. So let's go to assets. As we said before, it has non-current assets, which has property and equipment. Something to note about, you can see there is notes. So in any annual reports, there is always notes. So when you say property and equipments, you need to go down in the notes and know what kind of property and what kind of equipment. Because some equipment, some properties, they are not valuable, but maybe you have heard or you have not heard, some companies, they cook books or they just put non-existent things. So you need to go down and read what kind of property, what kind of equipment, and see whether those kind of properties they talk about, they are worth this much that they are reporting. So that's one. Intangible assets. Intangible assets, as we said, it's about patent rights, legal rights, about software. So those are the kind of assets that we are talking about. And actually, personally, I don't like a balance sheet that has more intangible assets. As I said, for example, if the company goes under liquidation, it's very, very hard for you to recover this because you cannot see them. For example, if it is a software, for example, if it is a patent, and the company goes under liquidation, it will be nothing because you cannot sell, you cannot do anything about it. So mainly, I try to avoid companies that have more intangible assets than the property and equipments. You see, you can see also even goodwill. Goodwill, most of the time, is always about company image, something like that, brand name. So those are the kind of goodwill. So basically, that's what is under assets. Also, there's a deferred income tax. Deferred income tax, it actually comes about when there is a discrepancy in accounting. Maybe you could have, the company could have overpaid. So it means next year it may pay less because it paid more because of the discrepancy in accounting. So that's how the deferred income tax arises. So that's the non-current assets. So when we go to current assets, we can see inventories. So inventories, you can see it increased from 440 to 458. Actually, inventories, when you go to inventories, one of the things to note about inventories is, for example, if the company's inventories are increasing over time, that is not a very good sign, because inventories in a storage, for example, like this is a publishing company, it should be selling its books. So if the inventories are increasing, it means they are not selling. But if the inventories are reducing, it means the company is selling. That's basically what it means. But mainly, I prefer to read through 6 years and above so that I can see the whole picture, because 2 years is not good enough. So if you're going to read through the company financials, especially also the balance sheet, you need to read the past 5 years, and that's when you can get a clear picture of company's performance. So let's go to trade and other receivables. Basically, trade and receivables, for example, if they give invoice to a company, if they supply some items and they're not yet paid, so they're expecting some money. So depending on what kind of receivables are, as I told you, you can see notes. So if you go to note 18, you'll find what kind of trade and other receivables are in the report. And so you need to also always read through and check what kind of items are in the notes, so that you get a clear picture of what kind of items they have reported. So let's go to another item of current assets. It's a cash and bank balances. This is a direct bank cash and bank balances. You can see it reduced. So if the company has more cash and bank balances, this is a very good, because it has opportunity to take up, to invest in other maybe innovation, to invest in other subsidiaries, or to do any other thing that is needed. It can also pay the day-to-day costs. So it's very important. Also, you can see it reduced, which is not a good sign, but as I told you, you need to give a picture of 5 to 6 years to check the clear picture of a company. So that's assets. So another item on the balance sheet, as I said, it is equity, shareholders' equity. So you can say equity attributable to the owners. So there is one that is share capital. Share capital basically is the capital that is, for example, if the company sells shares or releases shares and it sells, that is the amount of money that is received from the selling of shares. That's what is called share capital. Then a share premium, for example, in most cases when the company issues shares, there is a certain amount of money that it expects to get from the sale of shares. So for example, if it expects to get million Kenyan shillings or million US dollars, and it gets 1.5 million, so the balance, that additional 500,000, that's what you can call share premium. So when you go to retained earnings for the companies that do not issue dividends, it's basically the net income. So, but when you go to the companies that issue dividends, it means the net income minus the dividends. So that's what retained earnings is. So in the next maybe episode, we shall talk about how do you get the net income, because here we are talking about the balance sheet, but net income, in the next episode, we shall know what net income means if you don't know about it. So translation reserve, this is mainly because of the publishing company, because mainly this is not always presented to other balance sheet. So non-controlling interest, this is like the minority interest. This is most of the time is not always a big figure, so you shouldn't mind about it. So let's go to another item, which is the third one, which is the liabilities. As I said, any cost to the company is a liability. So let's go to this one. The good thing is it has current liabilities, only current liabilities, but the other companies, they always have non-current liabilities. So let's go to trade and other payables. This trade and other payables, mainly salaries and wages most of the time. Also, if some companies supplied them with any items or anything, they sold them. So these are the things that they should be paying. But as I said, always go to the notes and check what kind of payables they are going to be paying for. So that is another item. Then current income tax. Current income tax, just it's income tax that they will be paying soon. So income tax is just the tax that is derivative from the earnings, the income that you earn. As simple as that. So borrowings, You can see from here 509 million to 360. So is another liability, but from the report you can see the borrowings reduced. Anything relating with the borrowings, if the borrowings are reducing over time, that is a very good sign. But if the borrowings are increasing over time, that is a negative sign. So let's go to another item, which is bank overdraft. Bank overdraft, those who don't understand, is for example, if you have on a bank account, you have $1 million on your account, and you withdraw more than like 1.5 million, it means you made overdraft because you withdrew more than what you have on your account. Because most of the banks, if you're a client and they're a customer, they will accept the overdraft if you apply for it. So basically that is all about the balance sheet. But something to note about the balance sheet, for example, on liabilities in general, if over time the current liabilities are increasing, for example in the past 5 years, and they are not reducing, mainly borrowings, that is a negative sign. And also if you go to assets, and if assets are increasing over time, that means that is a good sign. This one, intangible assets, you should always look for it. If they have, a company has more, for the IT companies, if they have intangible asset, that is reasonable enough, because most of the IT, they deal with network systems, computer, software, so that one is understandable. But for the other companies that don't deal with the technology, having more intangible asset is always a red flag. So basically that was all about the balance sheet. And if you have any questions or have anything else you want me to talk about, please do not forget to comment in the below section on what topic you want me to talk about. Once again, do not forget to subscribe so that you don't miss other videos like this. Thank you for watching. Have a good day. Bye bye.